Welcome to the Pro Ticker Deep Dive. Okay, let's dive in. You look at energy headlines lately, and it's just, chaos seems like the right word. Geopolitical stuff, crude prices swinging wildly, market volatility. It's enough to make your head spin. But today, we're actually stepping back from that noise. We're doing a deep dive into something maybe less flashy, but fundamental. The midstream energy sector, that sort of middle ground infrastructure.
That's exactly right. We're focusing on the companies that form the logistical backbone, really, for the whole energy system. We're talking pipeline operators, the big storage facilities, the processing plants. They handle everything from crude oil to natural gas and, importantly, NGLs.
Okay, hang on a sec. NGLs, that term gets thrown around quite a bit. Maybe quickly define that for listeners.
Good point. NGLs, natural gas liquids, are super important. Think of them as these high-value components you get when you process natural gas: ethane, propane, butane, things like that. The midstream sector is where these get separated, stored, and basically prepped for use in chemical manufacturing or for export. They're a huge piece of the infrastructure puzzle.
Got it. Perfect. So the central question we're tackling, based on the sources we looked at, is this. Is midstream energy the stealth outperformer nobody's really paying attention to? Because while commodity prices are all over the place, these infrastructure players have been, quietly churning out consistent cash flow. And pretty attractive yields, too. They showed real resilience in 2025. So our job today is to figure out if that quiet strength is, built to last. Is it sustainable into 2026?
It's interesting. Historically, these stocks often just traded in lockstep with oil prices. Crude down, pipeline stocks down. But structurally, that link seems to be weakening, which is a big part of the resilience story you just mentioned.
Let's talk about the bigger picture then, the macro environment that allows this insulation, I guess. The whole global energy conversation seems caught between two things, right? The push for transition to renewables and the ongoing absolute need for reliability from fossil fuels.
Exactly. And midstream operators are right in the middle of there, the connective tissue, making sure that reliability piece actually works day to day.
They connect the supply and the demand.
Precisely. And that role provides a certain stability. While everyone's debating the transition timeline, crude oil has actually been, surprisingly stable, mostly hanging out in that $70, $85 barrel range for quite a while now. But the real difference maker, the structural shift, is how these companies actually make their money now.
This is where the contracts come in, right? Less exposure to the actual price.
Exactly right. Their earnings are much less tied to the spot price of oil or gas today. They've really managed to insulate themselves from that commodity noise.
Yeah.
By moving overwhelmingly to fee-based contracts. Think of it like they stopped betting on how much the taxi ride costs, that's the oil price, and instead they just focused on collecting a predictable toll for every single barrel or cubic foot that moves through their system.
The toll road model. Makes sense. They get paid for the volume, right? Regardless of the price tag on that volume.
Spot on. And even though natural gas prices have been, definitely more volatile than oil, you still have huge, dependable drivers for volume. U.S. LNG exports are one big factor, and just regular seasonal demand is another. Those things keep the gas flowing, and those fee-based contracts keep generating cash flow.
Okay, so let's connect that stability to the investment side, especially for people looking for income.
Yeah, the timing looks pretty interesting. You've got the Federal Reserve seemingly on a path towards gradual easing. Inflation is cooling off a bit, and that tends to bring investors back towards dividend-paying stocks seeking yield. So when you see midstream companies offering average yields in the, say, 6% to 8% range, that looks pretty compelling when risk-free treasury yields might be heading back towards maybe 3.5%. It's a strong relative value argument.
Okay, this feels like a key point from the sources because it suggests this isn't just a temporary upswing, it's structural. You're saying this is a fundamentally different kind of midstream sector compared to, say, 10 years ago. What makes it, I guess, smarter or more disciplined this time around?
It really is a completely different mindset. Capital discipline has become like the new religion for these companies. That whole era of growth at any cost, you remember when they were taking on tons of debt to build every pipeline project someone dreamed up, that's basically over. This is a much more mature, smarter way of running the business.
And there's actual data backing that up, right? The
Yeah.
sources mentioned capital spending. CapEx is way down.
Significantly down. Yeah, capital expenditure levels across the sector are running something like 40% below where they were at their peak in the mid-2010s.
40%! That's a huge cut. But how do we know this is a permanent change in strategy and not just them tightening belts because interest rates were high for a while?
That's a fair question.
Yeah.
I think the permanence comes from a couple of key operational shifts.
Yeah.
First, the focus now is on optimizing the assets they already have, not just building new ones. So heavy investment in things like automation, better flow monitoring, predictive maintenance, getting more out of the existing pipes, running leaner. Second, that 40% of cash that isn't going into new construction. It's now going back to shareholders' dividends, buybacks, or paying down debt. It fundamentally changes the risk profile. Management is now incentivized to maximize free cash flow, not just build the biggest network.
So less building, more optimizing leads to healthier balance sheets. And that cash also fuels consolidation. The source is called the M&A activity, quiet but real.
It is mostly what you'd call tuck-in deals. The larger established players are buying up smaller gathering and processing outfits. This helps them consolidate their footprint in the really key production areas, like the Permian Basin out in Texas or the Haynesville shale gas region in Louisiana. It makes their whole system more efficient.
Makes sense. And you mentioned earlier, while crude and NGL volumes are pretty stable overall, there is one specific area seeing real volume growth.
Yes, LNG, liquefied natural gas. Specifically, the infrastructure needed to support U.S. exports. The Gulf Coast corridor is just booming as a hub for shipping natural gas globally. That build-out means guaranteed volume growth for the midstream companies operating there, almost regardless of what domestic demand does. It's a pure throughput story.
What about the future, though? Are these companies just managing legacy fossil fuel assets that will eventually fade away? Or are they positioning for the energy transition, too? How do they handle that ESG skepticism we sometimes hear about?
They are definitely building bridges. That's the optionality piece we touched on. Some of the forward-looking operators are making investments, albeit small ones right now, in things like carbon capture pipelines or hydrogen blending infrastructure. Today, the revenue from that is tiny. Let's be clear. The core business is still pipelines for oil and gas. But these investments signal a path forward. And importantly, they could potentially attract different pools of capital down the road, maybe ESG-focused funds, which helps address that long-term risk perception.
Which brings us neatly to valuation. This is kind of the core of that stealth outperformer idea, isn't it? If the business is so solid, stable cash flow, good yields, disciplined spending, why aren't the stocks more expensive? They're trading around, what, 9 to 10 times forward EBITDA?
Yeah, roughly 9 to 10 times. And you're right, that is noticeably below the historical range. Back in the, let's call it the Wild West days, they might have traded closer to 12 or 13 times EBITDA.
So why the discount now, when they're arguably better run?
Well, that old 12-13x multiple often came with a lot more baggage-heavy debt, overbuilding risk, you name it. Today's 9-10x suggests the market maybe hasn't fully bought into the structural improvements we've been discussing. It seems the discount is driven more by perhaps some investor fatigue from past disappointments and that lingering ESG overhang rather than any real weakness in the current fundamentals. It feels like a bit of a disconnect.
So for someone investing primarily for income, how safe does that 6% to 8% yield look heading into 2026?
The security looks pretty robust, actually. The key metric we look at is the distribution coverage ratio. Across the main players, it averages around 1.6 times. What that means is, for every dollar they pay out in dividends or distributions, they're actually generating about $1.60 in cash flow available for those payouts. That 60-cent cushion provides a lot of protection, even if volumes were to dip a little bit in a slowdown.
And presumably the stronger balance sheets allow for more than just dividends, buybacks maybe?
Exactly. Better balance sheets provide that flexibility. We've definitely seen several of the major midstream companies actively buying back their own shares, maybe 2% to 4% of their shares repurchased this year in some cases. That directly helps shareholders. Fewer shares outstanding means metrics like cash flow per share automatically get a boost. So yeah, the overall picture is much cleaner balance sheets and payout ratios that look far more sustainable than in the past.
Okay, that paints a pretty compelling picture. Resilience, discipline, shareholder returns. But, nothing's ever completely risk-free, especially in the energy world. To really assess sustainability for 2026, we need that balanced view. What are the key risks listeners should keep an eye on?
Right, it's definitely not immune. We flag three main risks that mean you can't just set it and forget it. First, there's the regulatory overhang. Getting permits for new pipelines, dealing with environmental reviews. It's still a complex and often slow process, particularly in certain regions. That makes big, new organic growth projects challenging.
But wait a minute. If, as we said, energy reliability is such a huge global focus, wouldn't that put pressure on regulators to actually speed things up?
Logically, you might think so. But the risk isn't just about the speed of permitting. It's also about the uncertainty and the potential for legal challenges after a permit is granted. Multi-billion-dollar projects can get tied up in courts for years, even with initial approvals. That ongoing uncertainty reinforces the capital discipline we talked about, but it definitely caps the potential for really rapid expansion.
Okay, regulatory hurdles. What were the other two big risks?
Second is interest rate whiplash. Things look favorable now with rates potentially easing, but if inflation were to unexpectedly surge again, or the Fed had to suddenly reverse course and hike rates aggressively, well, Treasury yields could shoot back up. And that would pretty quickly shrink the relative appeal of midstream 6–8% yield. That income advantage story becomes less powerful.
Makes sense. And the third risk, commodity shock.
Correct. Even with fee-based contracts, they aren't completely disconnected from commodity prices. Think indirectly. If oil or gas prices were to crash dramatically and stay low for a long time, it would eventually impact the drilling activity of the producers, their customers. If producers stop drilling significantly, eventually that means less volume flowing through the pipes down the line. That could start to bite into those fee revenues, especially if contracts have minimum volume commitments that suddenly aren't being met.
Okay, so summing up the investment angle, it sounds like this is more about patience and endurance rather than chasing quick hype. Defensive stability, quiet compounding, but you absolutely need to keep those risks, regulatory, rates, commodity shocks on your radar for the 2026 outlook.
Definitely. And for those of you who do track the charts, maybe a quick technical perspective, the main midstream index has been at a pretty steady uptrend since about March. It's been grinding higher, which is generally constructive. Momentum looks positive overall.
Are there specific levels people should watch to gauge if this trend is holding?
Yeah, key support seems pretty well established in the 2,400 to 2,420 zone on the index. That's where buyers have consistently stepped in on pullbacks. On the upside, the main resistance area to watch is roughly 2,580 to 2,600. A clean break above that would likely signal the next leg higher.
And in any tactical thoughts for actually putting capital to work?
Well, generally for a more disciplined approach, scaling into positions on dips towards that support level is often preferred over chasing strength if it breaks out above resistance. And when you look at individual company performance within the sector, the ones really standing out tend to be those with the cleanest balance sheets specifically, keeping their debt leverage below about 3 times EBITDA.
Excellent. A really thorough deep dive into what seems like a surprisingly resilient part of the energy market. I think the synthesis is pretty clear. The sources really point to midstream as a place where maybe patience pays off. You know, if the headlines are screaming volatility, maybe the steadier money is being made where the balance sheets look solid and the business model is, well, maybe a little bit boring.
Boring is beautiful sometimes. And maybe a final provocative thought for you to chew on. We talked about the focus on energy reliability, right? And the friction involved in permitting traditional pipelines. So thinking ahead, how quickly could those small optionality investments in things like hydrogen transport or carbon capture infrastructure, how quickly could they scale up and become a really significant part of the revenue mix, say by 2030, if building traditional pipelines keeps getting slower? Could that attract a whole new type of investor to the space?
Something to definitely think about. Great discussion. See you all in the next Pro Ticker Deep Dive.